can all hear me. Today we celebrate the birthday of Milton Friedman. Here's a man who had more great ideas than any other economist in my lifetime. Most of you are familiar, I think, with Friedman's ideas from Free to Choose, the famous book that he wrote, and then a television series. And I think that in that, Milton Friedman was the most logical, eloquent economist who's ever written. And I think a lot of his impact was in his ability to communicate ideas. Friedman, of course, made the case, the argument for freedom of choice in everything we do. Our jobs, our health care, our education, and really laid down a marker for a free society. I last heard him speak here in Denver a few years ago for school choice, and he was just as logical and eloquent then as he was earlier in his career. Well, for me, talking about Milton Friedman is like talking about my career as an economist, because I have to tell you, I started out studying economics in the 1950s. Now, if you studied economics in the 1950s, you learned Keynesian economics. In fact, that's all you learned. Literally, monetary economics was not taught. You might read about the monetarist tradition in a history of the economic thought course, but the mainstream economists tended to assume that money doesn't matter, that we can use Keynesian fiscal policy to fine-tune the economy. And so we were trained as economists then we could go to Washington and fine-tune fiscal policy and monetary policy like a plumber and reach some optimum level of employment and output. But economists don't talk that way anymore. And we don't talk that way because of the work of people like Friedman. The major confrontation of ideas when I was an undergraduate student was actually between the socialist economists based in Cambridge, England, and the Keynesians based in Cambridge, Massachusetts. But I did have an opportunity to take a sabbatical in Cambridge, England, and learned a little bit about the monetarist tradition. And what I learned is that the monetarists like Friedman were not treated very well. They had some monetarist economists there, and they frankly didn't treat monetarists very well in the academic profession. Well, of course, Friedman challenged the whole Keynesian theory and wrote this wonderful work in monetary theory for which he won the Nobel Prize. But my exposure to Milton Friedman was primarily as an economic historian. And Milton Friedman, about that time, wrote the most important book, in my view, in economic history, A Monetary History of the United States. And I was later, when I wrote my textbook in U.S. economic history, I used that. Milton Friedman and Anna Schwartz wrote that book. And I used that as the basis to trace the evolution of monetary and fiscal policy in the United States. Friedman's most important chapter in that book is the monetary interpretation of the Great Depression. And in that chapter, what Friedman and Schwartz argue is that the Great Depression was not a market failure. It was not the collapse of capitalism. The Great Depression was a government failure. And it starts out with the Smoot-Hawley tariff, which is the worst tariff, the highest tariff we had introduced in a century. Every other country responded to that tariff with their own protectionist tariff. Not surprisingly, world trade and capital markets collapsed. And of course, as that happens, the financial system starts to collapse and banks start to fail. But the important insight that Friedman had was that the Federal Reserve System blew it, because the Federal Reserve Bank had been created to stabilize monetary growth, and indeed had stabilized monetary growth in the 1920s. But in the 1930s, the Fed sat back and watched the banking system collapse. There's no time in the 1930s where the Fed did anything to maintain stable growth of the money supply. Similarly, people think that the New Deal is what got us out of the Great Depression. There's no time in the 1930s when fiscal policies had a positive impact on economic activity, because any increase in spending associated with the New Deal was offset by higher taxes. What the New Deal really did was to basically take away economic due process. Economic property rights were basically thrown out the window. With the expansion of federal regulation, federal ownership of enterprises, with the expansionary fiscal monetary policies, with new entitlement programs. Of course, what happened was a great deal of uncertainty for creditors, for entrepreneurs, and it's fair to say that it wasn't really until after the Second World War that we started to get rules of the game that again created a positive business environment where there was an incentive to invest and grow and be productive. So we've spent half century dismantling much of the New Deal, all the damaging legislation in banking and finance and agriculture and transportation and energy and so forth. What I'm going to try to argue today is that we seem to be repeating the New Deal. But before I get to that, I want to talk about monetary policy, because in the 1970s, that's the period when Milton Friedman's monetary theories and ideas really gained traction in the economics profession. And for an obvious reason. We were experiencing stagflation. The government was pursuing a Keynesian expansionary fiscal policy, and we, of course, had an accommodating monetary policy. The outcome was higher unemployment, higher inflation, and lower economic growth. Keynes has no way of explaining that. And of course, what Friedman had in his monetary theory was an explanation for why that is a disaster and why this country needed to reverse those policies. So basically, Friedman's message was very simple. Government's too big, it's too expensive, and it's too intrusive in our daily lives. And what Friedman argued is if we want low inflation, we have to have stable growth of the money supply. If we want economic growth, we must have lower taxes and less government regulation. If we want to preserve capitalism and individual liberty, we must decrease the size of government relative to the private sector. Of course, this message became very important when President Reagan began to pursue some of these policies to reverse a half century of disastrous policies. And under Reagan, we had the first test of Friedman's monetary rule. The money supply should grow about the same rate as GDP, maybe a little bit higher because there's productivity advantage. And so under Reagan, we had the first monetarist monetary policy. Not surprisingly, in the previous decade, money grew at double-digit rates, and under Reagan, we brought the monetary growth down below 5%, and not surprisingly, over a period of time, inflation comes back to the target rates of 2 and 3%. And of course, Reagan was the first to really enact Friedman's tax policies, his fiscal policies. What Friedman argued for was low, flat rate taxes. And of course, Reagan's great success was tax reform, cutting the top marginal income tax rate more than half. Reagan wasn't as successful on the spending side. He was one of the few presidents who was able to constrain the growth of non-defense spending in order to allocate more resources to defense spending. But what these more prudent fiscal monetary policies did was create the basis for the most rapid economic growth of the post-war period in the 1980s and the 1990s. Well, about this time, I was a professor leading the quiet life of the academic up at the University of Colorado, believe it or not. And I'd written some books and articles supporting Friedman's monetary ideas. And I got a call from John Andrews. And John Andrews says, I'm starting this new think tank called the Independence Institute, and you're the only conservative economist I found in Colorado, so you are my first in develop. And he didn't give me a choice. So I started writing issue papers and editorials, first for John Andrews, then for Tom Tancredo, and now for John Caltera. And what I have to tell you is these guys have ruined my life. Thanks a lot. I got appointed to a tax commission, which put me at the center of the controversy about Tabor. I got, and by the way, I was attacked by Governor Bill Owens for defending Tabor and criticizing referendum C and D. He wrote an editorial in the Boulder Camera attacking my views. Then I got appointed to a PARA commission to try to reform PARA, and